It was a huge week for the financial markets. Let's go over some of the highlights we've seen this week. The Fed had their FOMC meeting and they decided to leave rates unchanged. They also hinted that there will not be a rate cut coming in March.
Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. I don't think it's probably not the most likely case or what we would call the base case.
Previously, the markets had priced in like a 50% chance for a rate cut happening in March, and now it seems that is off the table. Now the markets are pricing in the earliest rate cut would happen in May, and they're still pricing in several rate cuts for this year.
Now, what it does tell us is May is basically a gimme. That is going to happen as of now unless things dramatically change, as is, again, going out to June, July, and even September. So again, it looks like the market is still, and this is pretty amazing, the market is still pricing in 6 rate cuts going forward into the end of the year, and that is very, very impressive to see that the market, even with the Fed kind of being a little bit more hawkish, is still calling the Fed's bluff. That's what the market's doing here.
The U.S. economy remains pretty strong, and the GDP grew by 3.3% in Q4. That's compared to a 2% gain that Wall Street had predicted, so that's a pretty big increase, and it's part of the reason why the Fed is reluctant to start cutting interest rates anytime soon.
With strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back.
The job market is also remaining pretty strong throughout December, and there were a lot of jobs added for all of 2023. We had higher than expected GDP and higher than expected jobs growth. However, in January, there were a lot of companies doing layoffs, and the latest ADP data suggests that jobs in the private sector is slowing down, so there may be some cracks forming in the labor market. Now let's take a look at the charts for the overall markets. As you can see, at the end of January, there was a big sell-off, but we have since rebounded. The markets first sold off because of the Fed's meeting, and then after a day of digesting, they thought it was no big deal, and they regained pretty much all of that loss.
Everyone is working. People's bills are being paid. The market seems fine. The economy seems fine. It certainly could change, and I think if we were going to interest rates of 6% to fight inflation, everyone would be singing a different tune. That's not what we're talking about. We're talking about the first cut moving from March to May. To me, it's a very big, no big deal.
Yeah, obviously a bit of a knee-jerk reaction in the market.
What's interesting is the bonds have also rebounded down from the low of the 93s all the way up to the 98. So that's about a 5% move in just a matter of a few days. Big tech companies also reported earnings this week. And the theme is if you are on expectation with Wall Street's estimates, then you pretty much didn't really move anywhere. Maybe you even moved down. But if you were off target, you got punished severely. Microsoft reported their earnings and was pretty much in line with estimates. However, they still got a big sell-off during the day of the report. They have since rebounded a little bit, but it seems like if you're not beating heavily on earnings, you're going to move down. AMD also reported their earnings and there was a slight miss, so as a result there was a huge drop in their price. Now they have rebounded a little bit, but you can see that the markets are pretty tough if you miss on your financials. Taking a look at Nvidia, it is very highly overbought, and their earnings is not until near the end of February. So they could see a similar situation to AMD, which if their earnings come out as expected, they could also see a big drop because of this huge rally that they've had. The only way that Nvidia could go higher, I think, is if they report a big surprise in earnings, which is kind of hard to do given the huge run that they've had. You can see from all these indicators here that they are very, very overbought right now. For Google, they were pretty much in line with estimates. However, they gave a weaker than expected forward guidance, and as a result, there was a huge drop in their price. So if your guidance is not high, you're going to get punished in these markets. Same thing with Apple. They just reported earnings last night, and as you can see, they have come down from 186 all the way down to 181. Much of this was due to the slowdown in the Chinese economy, but the theme here is the same. Two companies that have surprised to the upside are Amazon and Facebook or Meta. Amazon shares are up from about 160 to 170. They've increased their free cash flow by a huge amount.
They beat on their earnings per share, they beat on their revenue, they matched their AWS expectation, and they beat strongly on their advertising. That looks like a fantastic quarter by the metrics. So the second highest quarter to this most recent one is $15.61 billion. So $15.5 billion compared to $28 billion. Amazon's most recent quarter will look like this. We'll go to 20 right here, and then we'll speed up to 25, and then we'll go all the way up to 28. That's what it's going to look like. It'll look like a mistake. People look at this and say, is that right? It looks wacky. There's one quarter that's massively spiked over all the other ones. There must be some data issue or something. Nope, that's reality. Those are the real numbers right from their earnings report.
So this surprise led to a big up spike in their share price in the after hours market. Meta also had a huge beat on their earnings report, and they've also announced a new dividend that they're about to pay out. So their stock went from $3.94 all the way to $4.54 in the after hours.
So Meta beat on everything last quarter, and then they also declared this quarter that they're paying a quarterly dividend. So a new quarterly dividend every single quarter. They're probably going to raise it every single year, making this company fit into the category of a dividend growth company.
So aside from Amazon and Meta, most of the big tech stocks have been trending lower. Taking a look at Bitcoin, it did have that huge drop following the ETF release, down to about 38,600, but it did bounce back up to the 43,800 level. So in the near future, it might be trading sideways in this range here. So anywhere between the 39,000 to 40,000 level and the 44,000 level, unless something drastic were to occur. A lot of people are still projecting that it would go down to 38, maybe to the 36,000 level before the halving event happens. Now the last crypto chart I want to take a look at is Chainlink. As you can see, ever since November, the beginning of November, Chainlink has followed this pretty beautiful pattern right here, remaining in this channel. Now the price range that it's been around is between the $17 mark at the high end and the $13, $13.5 level on the low end. Right now it's spiked up pretty high to about $18, but I would expect it to come back down to $13.7 and it might just continue this wavy pattern until the halving event. But if you take a look at these indicators, every time they've printed, Chainlink has fallen back down to the lower levels and then bounced back up. So Chainlink and Bitcoin may continue to trade in these levels unless something drastic happens. Let me know if you found this summary video helpful, and if you did, give it a like and a subscribe to the channel. Thanks.